Okay, in part two, we'll finish our discussion of analyzing financial statements. And in this instance, we're going to first talk about leverage ratios. And before we get too started with this, most of the ratios that we look at reflect an outcome. They reflect the result of making business decisions that ultimately reflect things like expenses, sales, etc. But leverage is different. Leverage is the one set of ratios that really reflects a choice. There is one decision and one decision alone that is recognized with respect to this set of ratios, and that is how much money has the owners of the company gathered from outside the company, from outside the ownership. In other words, how much money has been borrowed in order to purchase the assets that the company is using. So the two ratios that reflect this, and they are very similar, they give essentially the same basic answer, but it's looked at slightly differently. The first one is the debt to equity ratio. How much total debt is there relative to the owner's equity? In other words, what's the relationship of the money that is borrowed to the money that is invested by owners? Another way to look at this is the smaller this number, the more skin in the game that the owners have, because that would reflect less leverage, less debt. The debt to total asset ratio looks at how much of our assets have been purchased with borrowed funds. So it's total liabilities divided by total assets. And again, depending on your company, depending on maybe what textbook you learned from, these ratios can be slightly different. For instance, this debt to equity ratio, frequently you may see it as being long-term debt to owner equity. So it doesn't incorporate the short-term kinds of financing that are more operational than financing. So here are the two ratios, debt ratio and debt equity ratio. And you can see that over time, certainly over the last 2 years, there has been a marked increase in debt. Now, if you look at the debt equity ratio, that's the gray one, you can see that it appears that financing, creditor money, long-term financing, borrowing has increased relative to equity. As far as the actual percentage, you can see that really about 20% more assets are being purchased by borrowing, which is kind of substantial. So there is a large increase in debt. Now, if you also look immediately after this increase in debt, you see that there is a downward trend that almost immediately starts. So what this might tell us is that in general, Coors doesn't have a problem borrowing money. They're not shy from borrowing money to buy the things that they want to buy. But as soon as they borrow the money, they are then in a process of trying to figure out ways to pay off that debt. So again, we see that there over the last couple of years, there is an increase in debt, but now it is now declining. Another question that we might ask about debt then is, can the company pay for the amount of debt that they have? That is, do they have enough income, profit, to cover the interest expense? Now, this is kind of a limited ratio because there's a lot more to borrowing than just interest. We have to worry about principal, right? We may have to worry about other fixed payments like preferred dividends might be included here. But in general, this just gives us a picture of a company's ability to make interest payments on the debt of the company. It's called the TIE ratio, or times interest earned. Now, if we look at this ratio, we can see that in general, Coors has around a 4 is what they maintain. Now, in 2016, there was Again, something happened in 2016. We're not sure exactly what happened in 2016, but something occurred in 2016. So, in general, it appears that the company maintains somewhere around a high 5 or a high 4 kind of number with respect to the TIE ratio. So the company shows in general an ability to make payment on debt. The next set of ratios are referred to as profitability ratios. When we think about profits, what I would like you to think about is more not what's left over, but how did we get there? That is, how does management control the expenses of running the company, right? Better control of expenses leads to higher profits. So the gross profit margin tells us how the company is controlling the expenses of production. So it's gross profit divided by net sales. The operating profit margin includes production expenses, but also looks at all the other expenses of running the company. Now, if you look at the number, it's earnings before interest and taxes. This looks at profit controlling expenses before we've looked at financing and taxes. So this truly is an operations number. If you're the manager who's running the production line, this is the number that you're most interested in. Are you able to generate profits from running the company itself? The net profit margin then is what we typically refer to as being the bottom line, right? The challenge with net profit margin is, as I mentioned here, it's kind of muddy. There's so much stuff above the net profit or the net income line on a financial statement that it really makes it difficult to understand how we got to this point. It is a good summary of what's going on in the company, but we really can't analyze where the issues might be. Are the issues in production? Are the issues in our marketing budget? Are the issues in our financing? Is our interest expense just eating us up? These questions can't be answered from this particular ratio. So again, if we look at over time, here's the gross profit margin. Seems to be relatively calm, right around the 40% range. It's nice. Operating profit margin, again, if you kind of ignore 2016, it appears that this number might be slightly down, going down a little bit. Not tremendous amount, but it is declining over time. That may be a concern. Maybe we want to look at some of our operating expenses like our salaries, our advertising budget, research and development, those kinds of things. And of course, our net profit margin, skipping 2016, again has been relatively calm over the last 4 or 5 years, hovering right around the upper 12.5 to 13% range. So we see that the company is generating a decent profit on its sales. Now, another thing we might want to do is turn the page a little bit and see, well, how much profit are we providing, not based on the sales we produce, but on the assets that we've actually purchased. And there are 2 ratios for that. Now, your textbook talks about return on assets. Return on assets is just net profit divided by total assets. The challenge with this number is it includes financing decisions. So if you want to make comparisons to other companies or to an industry, this could be a problem if they have different levels of financing. If your company is undergoing some dramatic changes in the way you finance. For instance, if we see for Coors, we saw that over time there are spurts where they borrow a lot of money and then it works its way back down. that makes it very difficult to make comparisons historically to this ratio because of the changing financial structure of the company. I personally think a better number to understand profits generated based on assets is to use something called BEP, Basic Earning Power. Basic Earning Power is EBIT, this operating profit, divided by total assets. So it stops short of financing choices and taxes to reflect the returns generated for the company. Return on equity ultimately shows us the amount of profit generated that belongs to the owners of the company, right? How much profit did we generate based on how much money investors have given us? And of course, all of these numbers, we would like higher numbers are better than lower numbers. So again, let's ignore 2016. Basic earning power has roughly been in the low 5s, upper 6s. That's the blue line. You can see that it actually shows some variation, but a little bit of an uptick in the last year. Return on equity has shown a huge, again, not even looking at 2016, but we've gone from almost 5.6% to 10.5%. I mean, essentially that's a doubling of return on equity over these 2 years, which is a substantial jump. Return on equity, again, has been fairly stable, but we also see in this last year, there's been a pretty big jump in profits. So the profits of the company in general seem to have an upward trend, again, ignoring 2016. If we look at market ratios, there are a couple of different things we need to calculate before we get there. The first thing we need to understand is something called earnings per share. And if you've looked at financial statements or you've studied financial statements, you know that this is a number that's published. It's very easy to find. But essentially, it's just the net income that's available for common shareholders. So you take net income minus any preferred dividends, and you divide that by the weighted average number of common shares that are outstanding. And again, without getting into detail about how we calculate that or how you determine how many shares outstanding there are, in general, this is just a profit per share number, right? Of course, shareholders would like to have more profit than less profit. But what does a company do with this earnings per share? They only do two things with it. They either keep it and it becomes retained earnings, or they pay it and it's a common share dividend. So the dividends per share number then is just a ratio, right? It's a proportion of this. So if earnings per share are $10 and they pay out $5 in dividends, that must mean they kept $5 to reinvest in the company. Again, strategically, how much dividends are paid and how much is retained, those are strategic questions that management's going to address throughout the business cycle. If we combine this earnings per share number to the market price, we end up with something called the PE ratio. The PE ratio talks about how investors feel about a company's future. They see earnings per share, it's a published number, and how they react to the information of the company, not just earnings per share, but how they feel about the company's above, the company's liquidity ratios, the company's return ratios, how they feel about this company. The better they feel about the company and its future, the more they're willing to pay to buy the stock. So a higher PE ratio reflects optimism, right? Owners want the stock. Demand for the stock is going up, so the price will ultimately go up. So we would like to see a number that's a little bit higher than lower. However, if this number gets too high, it might be reflective of a stock that's overpriced. As an investor, you would rather buy stocks that have relatively lower PE ratios. Why would you want a lower PE ratio for investment purposes? Because that means you're buying a good company. Again, assuming you want to buy it, you think it's a good company, and because it has a lower PE ratio, relatively speaking, it is cheaper to buy it. So if we looked at the relationship between earnings and PE ratio, again, you can see that there's some wide variation. Stock prices change, earnings change from time to time. So there is some relative differences with respect to the ratio, but you can see that in general it appears that the PE ratio might be declining a little bit. From this respect, you might think, well, maybe shareholders aren't happy with the track that management is taking them on. Maybe they're worried about the liquidity of the company. Maybe there's some other things going on in this company that we haven't spoken about, but are concerning investors, and they are not willing to pay the high price anymore. Of course, you can see that earnings per share has been increasing. In fact, over these last couple of years, as I mentioned, 2016 and on, there was an expansion of the company. So we have an increase in the earnings per share of the company itself. Another ratio that I don't have a slide to show how this changes over time, but it is a nice ratio to understand if you're looking at a company and trying to figure out, relatively speaking, what its value is. Is it overvalued or undervalued? And this is what's referred to as the PEG ratio. This takes the PE ratio and divides it by expected future growth rate in a percentage form. A fairly priced stock is going to have a PEG ratio between 1 and 2. If it's less than 1, we're talking about an undervalued stock. Greater than 2 is an overvalued stock. So again, if you're thinking about investing, you may want to concentrate on companies that have relatively low PEG ratios. Definitely, you don't want to buy a stock that has a PEG ratio that is greater than 2. This, again, might be an indication that this stock is overpriced. One of the last things we can kind of look at is something that's referred to as the free cash flow per share. Right? So this is the free cash flow divided by the average common shares of the company. So in this case, you can see that in the ballpark here, this number, I don't have a graph for this, but you can see that this number has been fairly steady until the last 2 years that have seen some substantial growth in free cash flow. So what is free cash flow? We've talked about this in some other videos. Free cash flow is the amount of money left over after the business has done everything they want to do this year. There's still money left over, and this money is available to make payments to the investors. So from free cash flow, we pay interest payments, we pay dividends, we can buy back debt, we can buy back stock. So those are the 4 things that we can do with this free cash flow. The bigger the number, the more comfortable our investors will be about giving us more money. So again, that's the end of our financial analysis video.